Patrick Vernon here, author of Venture Capital Strategy, How to Think Like a Venture Capitalist, with a 5-minute definition of venture capital. Most people probably think of venture capital as any investment in any startup, but venture capital has a specific definition with 3 major components. Venture capital is institutional, private equity investments in high-growth startups. By institutional, we mean that VCs get their capital from institutions, like the ones listed here. VCs are professional money managers who have a legal obligation, a fiduciary duty to maximize returns to their investors. A traditional VC firm is a partnership in which the VCs are the general partners. The institutions that provide the bulk of the funding are called limited partners, or LPs. By contrast, angel investors, while also investing in startups, are not investing with other people's money. Many corporations also invest in venture capital. A corporate VC is not beholden to LPs, but may have some strategic ties back to the mother corporation. Because VCs are professional money managers representing institutions, the first round of venture capital funding that a startup receives is called its first institutional round, and comes with a level of credibility associated with professional investors. Venture capital is a type of private equity investment. By equity, we mean a type of ownership. When VCs invest, they receive newly issued preferred shares of stock. These preferred shares bring special rights, a handful of which I cover in the book, but I highly recommend Venture Deals if you'd like more on deal terms. In an equity investment, there is no debt to be repaid. Rather, the proceeds will be split at the end between founders and investors. The end is called the exit and refers to the sale of the startup, either to a larger company or to the public in an IPO. This is also called a liquidity event and is very similar to, say, when your parents sell their house and recoup all the equity they've built through the years. Now let's look at how these private equity investments differ from public stocks. Public stocks are traded on exchanges and all the information about the transactions is public. VC transactions, on the other hand, are private. This means important details, like price, are unknown to the public unless the parties involved choose to disclose that information. Public stocks are liquid, meaning they can be quickly turned into cash. Private equity, on the other hand, is illiquid, sort of like a house. In order to sell private equity, you have to go through a process, including finding a buyer and negotiating a price. Lastly, VCs will take an active role in the management of the company, often taking seats on the board of directors. These are several ways that private equity differs from public equity. However, venture capital is but a small subset of the $4 trillion private equity market. While VC is definitely part of PE, they have very different cultures. At one extreme is the California startup culture, and the other extreme is Wall Street. Lastly, let's take a look at the types of startups VCs are using other people's money to invest in. Like other investors, VCs build a portfolio of investments. In this case, of course, it's startups. Whereas a traditional portfolio of investments would perform somewhat consistently across the board, VCs have a hit-driven investment thesis. It is a different risk-reward paradigm in which each investment must have the potential for outsized returns. This means that VCs must invest in companies that have the potential for super-fast growth. A home run investment is often defined as a startup whose exit could return the entire fund, thus resulting in the limited partners receiving all of their investment back with one exit. A common goal across the entire portfolio is to triple the fund with proceeds from exits. So when VCs look at new investment opportunities in startups, they ask themselves, could this startup return the fund, or could it contribute in a significant way to tripling the fund? Put it all together, and venture capitalists are professional money managers using someone else's money to invest in high-growth startups. This video was intended to give you a quick overview of the definition of venture capital. If you'd like to get deeper into the weeds, I encourage you to check out the website vcrazor.com and my book, Venture Capital Strategy, How to Think Like a Venture Capitalist.